There's a crisis building in the global economy that is deliberately being kept out of the headlines. And right now, in 2024, the financial system is following the exact same playbook of denial and deception that preceded every major crash in modern history, stage by stage, decision by decision, almost like they're reading from the same script that led to catastrophe every single time before. Corporate debt defaults are quietly accelerating worldwide, but the official reports don't tell you the full story. A dangerous gap is growing between what the public is told and the reality unfolding inside corporate balance sheets. Many companies are using sophisticated accounting tricks and strategically delayed disclosures to mask their severe financial distress. They are creating a Potemkin village of financial stability, while behind the facade, the foundations are crumbling. This isn't just about a few struggling businesses, it's a systemic rot that has been allowed to fester, hidden from plain sight. The official numbers are a fantasy, designed to maintain a fragile calm before an inevitable storm. One sneaky trick lenders use is the amend and extend deal. Instead of admitting a loan is a dud when a company can't pay, they just push the due dates way out. They change the loan terms and act like everything's fine. This keeps bad loans on the books, avoiding a default. It's a short-term fix that helps the company dodge bankruptcy and keeps lenders from taking a big hit. But it just kicks the can down the road, making the debt even worse. Private credit markets have exploded to over $1.7 trillion, and it's pretty scary how little we know about them. These markets lend directly to companies outside the traditional banking system, acting like a new shadow banking sector. Since their loans aren't publicly traded or regulated, the real default rates are totally hidden. This lack of transparency means lenders and borrowers can hide their problems on a huge scale. We're heading into a crisis blind, and the official default stats just don't cut it anymore. Compounding this deception are the very institutions meant to warn us of danger: the credit rating agencies. History has shown, time and again, that they often react far too slowly, downgrading a company's debt only after the damage is already done and a default is imminent. They are followers, not leaders. By the time they issue a warning, it's a confirmation of a crisis, not a prediction. This lag gives companies and their lenders a crucial window to maintain the illusion of stability, trapping unsuspecting investors and employees in a failing enterprise. The watchdogs are asleep at the wheel, or worse, they're complicit in the charade. You've got to wonder why this is happening. It is pretty straightforward. Banks and private lenders don't want to admit how bad their loans really are. If they did, their asset values would tank, and regulators would come knocking. It could even freak out their investors and depositors. So they team up with struggling companies to keep up the charade. They're not just hiding the truth, they're twisting the numbers to save their own skin while everyone else suffers. To achieve this, defaults are being systematically reclassified. What should be a clear-cut default is now being labeled a restructuring, a technical adjustment, or a distressed exchange. These euphemisms are carefully chosen to avoid triggering default clauses in other credit agreements, which would cause a devastating domino effect. A company might miss a payment, but as long as it's part of a negotiated restructuring, it doesn't officially count as a default in the statistics. It's a linguistic game designed to mislead the market, a deliberate effort to redefine reality to serve the interests of the powerful. All of this is happening against the backdrop of a brutal new economic reality. Since 2022, rising interest rates have doubled or even tripled debt servicing costs for countless corporations. Companies that were barely surviving in an era of near-zero interest rates are now being suffocated by their own debt. The cheap money that fueled their expansion and masked their weaknesses has vanished. Now, the cost of their past decisions is coming due, and the math is unforgiving. For many, it's no longer a question of profitability. It's a question of pure survival, and they are losing the battle. This has given rise to an army of zombie companies, firms that don't earn enough profit to cover their interest payments and are surviving only by taking on new debt to pay off old debt. For years, they could roll over their loans indefinitely. But now, with credit tightening and lenders becoming more cautious, these zombie firms are running out of options. The lifeline of refinancing has been cut. Their only path forward is bankruptcy, but the system is doing everything it can to prevent that from happening all at once because the shock would be too great to contain. The raw data, if you know where to look, is terrifying. Distressed debt levels, the amount of corporate debt trading at levels indicating a high probability of default, are the highest they've been since the 2008 financial crisis. But this data is fragmented, scattered across niche financial services, and deliberately underplayed by mainstream sources. The official narrative focuses on resilience and recovery, while the undercurrent of distress grows stronger by the day. The numbers are screaming a warning, but very few people are being told to listen. Private equity firms are in a tough spot, drowning their portfolio companies in debt just to rake in profits. With rising rates, these companies are really feeling the pinch. But since they're privately owned, their struggles fly under the radar, leaving a huge part of the corporate world in crisis without anyone noticing. It's a massive blind spot for the whole economy. While the official data in places like the US remains muted, the global picture tells a different story. Corporate bankruptcies have surged across Europe and Asia. This is the canary in the coal mine. The same economic pressures are at play everywhere, but some jurisdictions are less able to hide the fallout. The wave of defaults is already here. It's just not being acknowledged uniformly. The global nature of this trend proves it is not an isolated problem, but a systemic one, driven by the end of an era of easy money. For those who know how to read the signs, the market is already screaming danger. The prices of credit default swaps, CDS, which are essentially insurance policies against default, have been rising sharply. Bond spreads, the extra yield investors demand to hold risky corporate debt instead of safe government bonds, have widened significantly. Investors are not waiting for the rating agencies or the official reports. They are already pricing in widespread distress. The smart money is quietly positioning itself for a crash, while the public is being told that everything is under control. Another critical red flag is buried deep within corporate financial statements. Corporate auditors are flagging going concern warnings at a rapidly rising pace. This is an auditor's formal declaration that a company may not have enough money to stay in business for the next 12 months. It's one of the most severe warnings an auditor can issue, and it's happening with alarming frequency. Yet these warnings are often buried in dense regulatory filings, overlooked by a media ecosystem that prefers simple, optimistic headlines. And that media coverage is part of the problem. It focuses obsessively on a few big-name bankruptcies, making them seem like isolated incidents. But for every major company that files for bankruptcy publicly, thousands of mid-sized firms are defaulting quietly, their struggles managed behind closed doors through the restructurings and amend and extend deals that keep them out of the official statistics. This creates a deeply distorted picture of corporate health. It is like reporting on a hurricane by only mentioning the trees that have fallen in one neighborhood, while ignoring the fact that the entire city is underwater. There's a reason for this coordinated silence. Governments and regulators have no incentive to highlight the issue. Admitting the true scale of corporate defaults would signal a profound weakness in the post-pandemic recovery narrative they have carefully constructed. It would shatter consumer and investor confidence, potentially triggering the very recession they are trying to avoid. So, they prefer to look the other way, hoping the problem will magically resolve itself. They are choosing short-term political calm over long-term financial stability. But the truth cannot be hidden forever. The true scale of these hidden defaults could reshape investor confidence overnight once it finally comes to light. When the market realizes that the assets held by banks, pension funds, and insurance companies are not worth what they claim, panic will set in. The trust that underpins our entire financial system will evaporate, and the fallout will be swift and brutal. We are building a financial bubble based on manipulated data, and when it pops, the consequences will be devastating. The ripple effects will spread far beyond Wall Street. A wave of corporate failures will lead to mass layoffs and higher unemployment. As banks and lenders are forced to absorb losses, they will dramatically tighten credit for everyone, choking off the flow of capital to small businesses and households. Regional banks, which are heavily exposed to commercial real estate and corporate debt, will face immense pressure, risking a repeat of the banking crisis we saw in 2023, but on a much larger scale. This is not just a corporate problem, it will become everyone's problem. While the public remains in the dark, a select few are preparing to capitalize on the chaos. Hedge funds and distressed debt investors, the so-called vultures, are raising billions of dollars. They are quietly buying up the debt of struggling companies for pennies on the dollar, positioning themselves to profit from the massive wave of bankruptcies and restructurings they know is coming. They see the writing on the wall, and they are getting ready to feast on the wreckage. Their actions are the clearest sign that the crisis is not a matter of if, but when. This brings us to the key question, the one that should keep you awake at night. How long can the financial system keep hiding this corporate distress before the cracks become too big to ignore? The United States has already followed the script this far. We are not approaching the pattern, we're deep inside it. This is the story of how financial crises are born, why the system always thinks it can hide the truth, and why the math says this time won't be different. And it's happening faster than anyone wants to admit.